Well, thanks for that introduction, John, and thank you for inviting me back here again for another year to reassess what's been going on and to try and work out what the future looks like. Because there's no doubt that it still remains an interesting puzzle as to what's happening in the global economy and, of course, in the Australian economy as well. So let me start by just giving you some pretty basic forecasts. At the moment, the RBA cash rate's 1.5%. Who would have believed it could have got down this low? But I think that's probably about the bottom for the cycle. There will be, if there are moves, it will be down rather than up in the near term, and the timing of any interest rate hike, I think, will be many, many years away. But I think that we'll probably end up with a year of not much happening on the interest rate front. It's interesting that the new governor, we had two cuts in May and August that was very much driven off the fact that inflation kicked down below the 2% target that the Reserve Bank, 2 to 3% target that the Reserve Bank follows. The new governor made his name in the early 2000s when he was lecturing, writing research papers that unfortunately Mr. Greenspan didn't listen to, but when he was pointing out that monetary policy shouldn't just be focused on inflation, it should be focused on inflation plus what's happening in asset markets. And of course in the US between 2001 and 2004, US house prices lifted by 50%, and yet Greenspan was still cutting rates. This governor is very mindful of the interaction between interest rates, asset markets, and the fact that having really low inflation may not be the only thing that a central bank should be targeting. So the fact that we saw house prices in Sydney lift by 3.5% in the last 3 months and in Melbourne by 5% would have been a signal to him that the market that was urging him to cut rates in November is probably going to be disappointed. I certainly expect that we won't be getting any surprises on Melbourne Cup Day. Does that mean I'll be at Flemington in the grandstand backing winners? No, I'll still be at my desk just in case. But I suspect that we're in for a fairly long period of stable rates. The fixed rates have hit the bottom, I believe, and I think the pace at which they rise will be very modest because the floating rate will remain anchored at this low level. But I think we have seen enough evidence now to suggest that fixed rates will start to edge up. The US tightening rates in December, bond markets having now turned. The US long bond rate bottomed out around 1.45. It's now at about 1.65. And some really encouraging signs from from the two major central banks that have been doing quantitative easing, that maybe that will come to an end. I'll say a little bit more about that later. The Aussie dollar, I think, will be a captive of the US dollar. And I think if the Fed does raise rates in December, that'll take some pressure off the Aussie dollar. We're also expecting to see commodity prices heading back down again. Things like the iron ore price in the high 50s, when the major producers have been able to lower their costs down to the high 20s, are unsustainable. You'll find that these prices will start to move much closer to the cost curve as these large producers start to ramp up their production. And that, of course, will also take a bit of pressure off the Aussie dollar. Now, next year, I think the Fed will raise rates on 2 occasions. So that'll really mean that by the end of next year, US rates will be at nearly at around 1%, and Aussie rates at 1.5%. So that'll narrow that margin significantly, and that'll take further pressure off the Aussie dollar. Let me now make some overall comments about what's happening in the world at the moment. And a good way to look at it is to think about debt. So if we look at, here I'm looking at debt as a proportion of GDP. So the red line is corporate debt, the grey line is household debt, and the brown line is government debt. So if we think about Japan, Japan's big problem has been massive government debt. And that's really held that economy back from what should have been a much more aggressive fiscal policy. Because inflation is very, very low in Japan, and particularly because infrastructure is starting to age in Japan, Japan should have taken a much more aggressive approach to boosting fiscal spending, but it hasn't because of its concern about the level of debt. Could this create a potential imbalance in the world economy? Only if global investors held a lot of Japanese debt and made it more difficult for Japan to fund all of that government debt. But 95% of that government debt is held within Japan, so it's pretty much a closed story. Therefore, I think the opportunity is there for Japan to adopt a lot more aggressive approach to boosting their economy. Monetary policy has run its course. Fortunately, we've seen in the last two meetings of the Bank of Japan, the markets were disappointed that the Bank of Japan did not increase its purchase program. I think they realise now that they've run their course on monetary policy and we need to move towards fiscal policy, and the high level of government debt remains the constraint. If we take Italy, they've also got a lot of government debt, but much more of that is held by foreign investors. So it's a much more risky situation that the Italians find themselves in than, say, the Japanese. The Italians also have a number of other overriding problems. Their bank debt, bad debts in their banking system are about 18% of total debts. That compares with about 0.25% in Australia, and even about 12% we think, say, for China. The government is also quite fragile. They are going to have a referendum on the 4th of December to try and streamline the way their constitution works. The leader of the government has said if he loses the referendum, he'll resign. If there's a banking crisis or if he resigns for political reasons, the likely winner of any election is the Five Star Party, which was founded by Beppe Grillo, who's a comedian, and where all of his people have virtually no experience in running governments. They are currently running the local council of Rome, the local council of Milan and Turin, which has only been a recent development. But the point is that their key policy is to leave the euro. So if we were to get political upheaval, either because of a banking crisis or because of these political developments, Italy, being a core part of the euro, would be a much, much more destabilising factor than, say, the Brexit. The Brexit is difficult for the UK. Anyone that thinks it's not going to be a bad thing for the UK is really mistaken. UK has been able to cushion the blow with a very substantial fall in their currency, but now comes the time of uncertainty, lack of business investment, what happens to all the businesses in the City of London, etc. But in the case of Italy, if Italy was to leave the euro, that would really unsettle things. I think France and Germany were quite comfortable having the UK around the table. That's the one thing they had in common, and that was that they didn't like this third big guy. Now that he's left, there's not much that they've got in common anymore, so it's already going to be quite a destabilising situation. China is a problem in the sense that China's got too much corporate debt. Basically what happened in China was that when they had their big fiscal stimulus just after the GFC, so they used to get their growth from global trade. Global trade collapsed, so they had to rebalance their economy towards domestic spending. And they had a 15% of GDP over 2 years fiscal stimulus, 15%. If Malcolm Turnbull tried to get away with a 1 or 2%, he'd be criticised heavily. They had 15% over 2 years. But it was funded by the banks lending to the state-owned enterprises, who then went out and invested. What we're left with now is this massive legacy debt in the state-owned enterprises. The investments that they made, many of them never really generated the return that they were expecting, and so they're having to borrow more money to top up their debts, to pay wages, to keep their businesses going, so-called zombie companies. So China's sort of stuck in this situation where the borrowings are being dominated by the public sector. Borrowings in the private sector are collapsing because the private sector used to get its money out of the shadow banking system, but the shadow banking system is now being regulated a lot more. And the investment that we see in the private sector in China has collapsed, and all the credit is going into this public sector. So this doesn't mean that China's going to have a hard landing. It doesn't mean there's going to be a crisis, because it's government lending to government. But what it does mean is that China's potential growth is being adversely affected. And that's one of the problems that needs to be addressed. Now, the Chinese have realised that they have this fundamentally fragile model, But in their defence, they have a huge level of reserves, so they can protect themselves from the rest of the world, can protect this inefficient model because of these high reserves. So a run on the currency can always be rebuffed by the high reserves. But the level of reserves in China is a critical point, and it has direct implications for Australia. The US is the one that's in the best situation, and we are seeing a major development being the presidential election. For me, it's a really disappointing situation in the sense that Trump is much more aggressive on fiscal policy. If Trump gets elected, at least he'll be able to get things done because he'll be likely to control the Senate and the House. As you know, Obama lost control of the House back in 2010, so for the last 6 years he's been pretty much a lame duck president. Hasn't been able to get anything through because he can't get the Congress on his side. If Hillary gets elected, I suspect that the Republicans will still control the House, so she'll have real difficulty in making any major changes. Whereas if Trump gets elected, at least he'll be able to get things done. Now, some of the things he wants to do, I think, are the sort of things that the US desperately needs now. A big fiscal stimulus, tax cuts, and most importantly, a massive infrastructure investment program. That's what the US needs. The US is in the situation now where it can kickstart its economy and try and get us out of this difficult situation that the world economy's found itself in. Of course, there are other reasons why we would be disappointed to see a Trump victory, particularly around the impact he may have on global trade. So what we don't want to see is a situation where the global economy slows and everybody sees protection as being the answer to rebooting growth. And if his policies were to be dominated by that protection concept, that would be a negative. For us, you can see that our problem is household debt, and it's a big time issue. We don't have too many world records, but we do have world record household debt. And that, of course, is a legacy of the massive boom in housing that we've had over the last 20 years. The banks were lending at mortgages at about 20% pace, and deposits were growing around 7 or 8%, and the difference was made up by borrowing offshore. So the household debt is a direct reflection of foreign debt. And the household foreign debt is the issue that Australia has to deal with. It's not government debt. Government debt itself has deteriorated rapidly, but the starting point was so low. Our level of government debt is pretty good. Germany, as you can see, if you add corporate debt to household debt, you see Germany's got by far the lowest. And that means that they're not really operating their economy at a proper pace. They're not leveraging enough in that economy, either in the household sector or the corporate sector. A very cautious approach to growth. And of course now Germany has acquired what could be the biggest problem of all, which is the issue around Deutsche Bank. Deutsche Bank has been issued with a fine of 14 billion US, which we think will be reduced, but that's equal to the market capitalisation of their bank. They have on their balance sheet 47 trillion in derivatives, which is 12% of the global derivatives. And we know that word derivatives is something we get worried about when banks start to get into trouble. So this is a big issue at the moment. Some people say the only solution will be for a bailout from the German government. Others say that there will be other ways in which the Deutsche Bank issues will be resolved. But the theme of the European banking system sitting there as a major risk event for the European and world economy is something that we should not ignore. And if I was looking for something that would really surprise us and really create havoc in the world economy in the near term, that's where I'd be looking. I wouldn't be looking at China for the reason I said, it's government to government. I certainly wouldn't be looking at the US or Japan. They're the ones that we're hoping will be able to lead us out of this low growth environment that we've had. Europe would be the place that I'd be most worried about.